Welcome to this explainer. Look, let's just dive right in because honestly, we are looking at something totally unprecedented in financial history right now. Elon Musk is gearing up for the largest initial public offering, or IPO, we have ever seen. We are talking about a target valuation for SpaceX that is just, it's mind-boggling. And today, we're going to break down exactly how this whole thing impacts you. $1.75 trillion. I mean, to put that massive figure into perspective for a second, at that valuation, SpaceX would literally be worth more than every single American defense contractor combined. It would be worth more than the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks all put together. It even eclipses the top 10 companies on the entire London Stock Exchange combined. It is an absolute financial behemoth. But this presents a pretty glaring financial reality check. You kind of have to ask yourself a very logical question here. If SpaceX is losing a staggering $5 billion a year, who on earth is lining up to buy it at the largest IPO valuation in human history? It's a pretty compelling mystery, isn't it? Well, here is the stark reality. You are. Yeah, within a few weeks of this listing, your retirement account, your 401k, is poised to become one of the biggest buyers of SpaceX stock. And you know what the really wild part is? This is going to happen whether you actively choose to buy it or not. So to understand exactly how this works, we first need to figure out what SpaceX actually is. Section 1. 3 companies in 1. Deconstructing the myth. So, before we get into the financial engineering behind this IPO, we have to deconstruct the myth surrounding the company itself. Because, let's face it, the only way a nearly $2 trillion valuation makes any sense is if SpaceX is the company the public actually believes it to be. If you walk up to someone on the street and ask what SpaceX sells, almost everyone is going to tell you it's a rocket company focused on Mars. But that's kind of just a myth. The reality is that SpaceX is actually 3 completely distinct businesses stacked on top of each other. It's rockets, plus Starlink, plus an AI company called XAI. And surprisingly enough, the rocket business isn't even the most important piece of the puzzle here. If we dive into the actual revenue split for 2025, out of roughly $18.5 billion in total revenue, a massive 61% slice belongs to Starlink, their satellite internet provider. That brought in $11.4 billion alone. The rocket business, the part that actually gives the company its name and launches satellites and cargo into orbit, that only accounts for about 21% of the revenue, roughly $4 billion. So Starlink is absolutely the crown jewel paying the bills for the whole operation. And it's not just about the raw revenue either. It's about the incredible efficiency underneath all that. Starlink's current profit margin sits at a staggering 63%. Just 2 years ago, those margins were around 41%. That means this satellite internet business, which, remember, just launched in beta back in 2020 and now has over 10 million active subscribers, managed to add over 20 points in margin expansion in just 2 short years. The margins are fantastic and they are accelerating. Section 2. The consolidated cash burn, where the money goes. Okay, so if Starlink and the rockets are so profitable, where is that $5 billion loss coming from? Well, enter XAI. This is the AI lab founded in 2023 to compete with the industry giants, which SpaceX recently acquired in an all-stock deal that valued XAI at $250 billion. And this division is currently burning over $1 billion a month. But here's the real kicker. By March of this year, every single one of its 11 heavyweight co-founders had walked out, which forced the company to publicly admit the platform has to be rebuilt from the foundations up. So they basically paid $250 billion for an asset that needs to be completely rebuilt from scratch. When we do a reality check against the rest of the AI industry, the numbers are just jarring. You have OpenAI generating $24 billion in revenue with an $850 billion valuation. You have Anthropic generating $30 billion in revenue at a $400 billion valuation. And then there is XAI. It has an estimated revenue of just $1 billion, yet was bought for a staggering $250 billion. Financial analysts actually noted that the market is pricing XAI like a luxury airline, when financially, it's operating a whole lot more like a budget carrier. Analysts have actually come up with a rather funny analogy for this whole situation, calling XAI the reverse Jerome Powell. And it perfectly captures the dynamic. Instead of printing cash, XAI just exists to fiercely burn whatever cash the rest of the business, meaning Starlink and the rocket division, actually manages to generate. So the absolute crucial point is this. Starlink and the rocket business had a phenomenal year, bringing in roughly $8 billion in profits. But as a consolidated company, that flips into a massive $5 billion loss. XAI literally showed up, wiped out that $8 billion profit, and dragged the entire entity deeply into the red. Section 3, changing the Nasdaq rules. Rewriting the game. So how exactly does a consolidated company losing $5 billion a year manage to list at a $1.75 trillion valuation? Well, to make this work, the underlying rules of the game had to be completely rewritten. On May 1st, Nasdaq quietly rolled out what can only be described as a red carpet tailored specifically for this IPO, and they introduced 3 highly convenient rule changes. First up, the Fast Entry rule. This compresses the standard 3-month waiting period for a newly listed company to join the Nasdaq 100 down to just 15 trading days. Second, they removed the rule that required a company to have a minimum 10% of its shares available or floating for the public to buy and sell. And third, they introduced something incredibly complex, a hidden multiplier. Let's break down that hidden multiplier for a second, because it is by far the most secretive and impactful change. SpaceX is reportedly targeting a tiny free float of just 4 to 5%. Under the old rules, they wouldn't even qualify for the index. But buried in these new rules, Nasdaq now legally forces exchange-traded funds, or ETFs, to treat companies with a free float under 20% as if they are 3 times larger than they actually are. So with this multiplier, a 4 to 5% actual float is magically weighted in the index as a 12 to 15% float. When you combine a super fast 15-day entry, the removal of float minimums, and a legal requirement for ETFs to literally triple the weight of the available shares, what you get is pure manufactured demand. By dropping SpaceX into the gold standard Nasdaq 100 index so quickly, the financial system is essentially engineering automatic, unavoidable buying pressure from the hundreds of billions of dollars in passive index funds that are literally forced to track it.
Section 4. You are exit liquidity. Retail foots the bill.
And that manufactured demand, it directly impacts your wallet. There is a glaring disparity in this offering. In a standard IPO, the allocation reserved for everyday retail investors is usually kept somewhere around 5 to 10%. But for the SpaceX IPO, the target allocation for retail is a massive 30%. That means everyday investors are being specifically targeted to absorb an absolutely unprecedented amount of this stock. The company's stated justification for this is, well, quite interesting. Brett Johnson, the CFO of SpaceX, told bankers that they are targeting this 30% because, as the quote says, retail buyers have been incredibly supportive of us and of Elon for a long time, and we want to make sure that we recognize that. Financial analysts, however, translate that corporate speak a bit differently. They aren't dumping 30% of the supply onto retail for price stability. It's simply because of loyalty. Which brings us to this incredibly stark reality check from portfolio manager George Noble. Your 401k is the exit liquidity. See, the buyers and the sellers in this IPO do not show up at the same time. The rules have basically been structured so that early insiders sitting on a super low-cost basis can unlock their shares later, precisely as passive index funds and retail retirement accounts are forced to buy in, absorbing all that stock right at peak valuation. This really highlights the dark side of passive investing. I mean, for years, we've been pitched the benefits, right? Low fees, broad diversification, and total convenience. But the exact same mechanism that allows you to just set it and forget it also strips away your choice. It results in automatic buying without your input. The feature that makes it so incredibly easy makes you a guaranteed buyer for absolutely any company that manages to get the rules bent to squeeze into the index. Which leaves us with one highly provocative final thought to consider today. If the mechanics of passive investing have been rewritten to make you a guaranteed buyer for a company that is currently losing $5 billion a year, who is going to squeeze into the index next? With other massive AI labs like OpenAI and Anthropic reportedly eyeing their own public listings, you really have to wonder if these new rules were rewritten just for SpaceX or for an entire new class of companies. It's definitely something to think about the next time you check your retirement account. Thank you so much for joining me for this explainer, and keep learning.